Profit, also known as net income or the bottom line. Your profit shows the difference between what a business earns and spends. Calculate profit earned by subtracting total expenses from total revenue. Profit in accounting is an income distributed to the owner in a profitable market production process. Profit is a measure of profitability which is the owner's major interest in the income formation process of market production. There are several profit measures in common use. Income formation in market production is always a balance between income generation and income distribution. The income generated is always distributed to the stakeholders of production as economic value within the review period. The profit is the share of income formation the owner is able to keep to themselves in the income distribution process. Profit is one of the major sources of economic well-being because it means incomes and opportunities to develop production. The words income, profit, and earnings are synonyms in this context. There are several important profit measures in common use. Note that the words earnings, profit, and income are used as substitutes in some of these terms. Gross profit equals sales revenue minus cost of goods sold, thus removing only the part of expenses that can be traced directly to the production or purchase of the goods. Gross profit still includes general expenses like research and development, S&M, G&A, also interest expense, taxes, and extraordinary items. Earnings before interest, taxes, depreciation, and amortization, EBITDA, equals sales revenue minus cost of goods sold and all expenses except for interest, amortization, depreciation, and taxes. It measures the cash earnings that can be used to pay interest and repay the principal. Since the interest is paid before income tax is calculated, the debt holder can ignore taxes. Earnings before interest and taxes or operating profit equals sales revenue minus cost of goods sold, and all expenses except for interest and taxes. This is the surplus generated by operations. It is also known as operating profit before interest and taxes or simply profit before interest and taxes. Earnings before taxes or net profit before tax equals sales revenue minus cost of goods sold and all expenses except for taxes. It is also known as pre-tax book income, net operating income before taxes or simply pre-tax income. Net income or earnings after tax or net profit after tax equals sales revenue after deducting all expenses, including taxes, unless some distinction about the treatment of extraordinary expenses is made. In the US, the term net income is commonly used. Income before extraordinary expenses represents the same but before adjusting for extraordinary items. Retained earnings equals earnings after tax minus payable dividends. To accountants, economic profit, or EP, is a single-period metric to determine the value created by a company in one period, usually a year. It is earnings after tax less the equity charge, a risk-weighted cost of capital. This is almost identical to the economist's definition of economic profit. There are analysts who see the benefit in making adjustments to economic profit, such as eliminating the effect of amortized goodwill, or capitalizing expenditure on brand advertising to show its value over multiple accounting periods. The underlying concept was first introduced by Eugen Schmalenbach, but the commercial application of the concept of adjusted economic profit was by Stern Stewart and Company, which has trademarked their adjusted economic profit as economic value added. Optimum profit is a theoretical measure and denotes the right level of profit a business can achieve. In the business, this figure takes account of marketing strategy, market position, and other methods of increasing returns above the competitive rate. Accounting profits should include economic profits, which are also called economic rents. For instance, a monopoly can have very high economic profits, and those profits might include a rent on some natural resource that a firm owns, whereby that resource cannot be easily duplicated by other firms.